This is the third of 5 short talks I gave at the Symposium on Financial Crime held at Jesus College, Cambridge in late August 2026. The logic of financial innovation and the boundaries of financial crime. I'd like to begin with a provocative proposition. Many of the financial practices we celebrate today would once have been considered criminal, and many of the financial practices we condemn today may become tomorrow's accepted innovations. That should make us uncomfortable because it suggests that the boundary between financial innovation and financial crime is not fixed by economics, it is not fixed by technology, and it is not even fixed by law. It is fixed by power. For centuries, charging interest on loans was regarded as immoral and in many places illegal. Today, interest is the foundation of the global banking system. Short selling was condemned as market manipulation. Now it's considered essential for efficient markets. Derivatives were once dismissed as gambling. Today they underpin millions of billions of trillions of pounds of legitimate economic activity. History repeatedly shows us that yesterday's financial crime becomes today's innovation. But history also shows us the reverse. Activities that were perfectly legal have later been recognized as socially destructive. Aggressive subprime mortgage lending before 2008 was legal. Complex securitization structures were legal. Many tax avoidance schemes remain legal, yet their social consequences have been profound. So perhaps we are asking the wrong question. Instead of asking what is financial crime, perhaps we should ask who has the authority to define it. Because finance is not really about money. Finance is about trust, and trust is political. Every financial system is ultimately a set of rules determining who can create value, who can transfer risk, and who can accumulate wealth, and who can exercise power. When someone invents a new financial mechanism, they are not simply creating a product, they are challenging an existing distribution of power. That is why financial innovation so often appears threatening. The innovation of one era frequently looks like criminals in the incumbents of another. Consider the early bankers who created forms of money not backed directly by gold. To many contemporaries, this looked indistinguishable from fraud. After all, they were creating purchasing power from promises. Today, we call that process banking. The difference is not the underlying activity, the difference is social acceptance. What society once condemned as dangerous speculation became the foundation of modern capitalism. Now, let's consider cryptocurrency, whether you love it or hate it. Cryptocurrency poses an uncomfortable question. When governments create money, we call it monetary policy. When central banks expand balance sheets, we call it quantitative easing. But when private actors attempt to create alternative money systems, we often call it dangerous, destabilizing, or criminal. Why? Because perhaps the real issue is not money itself. Perhaps the issue is who is allowed to create trust. Financial history is full of examples where innovation challenged existing authorities. Some innovations failed, some caused enormous harm, some transformed the world, but almost all of them disrupted established interests. And disruption is often mistaken for criminality. That does not mean all innovation is good, far from it. Some of the most damaging events in financial history emerged from innovations that promised efficiency and prosperity. The 2008 financial crisis was not caused by a lack of innovation, but by an abundance of innovation. Complex securities, sophisticated models, and advanced risk transfer mechanisms all appeared legitimate. In fact, they were celebrated until suddenly they weren't. The lesson is uncomfortable. The market is not always capable of distinguishing innovation from exploitation. Neither, frankly, are the regulators. Both are often reacting after the fact. And this brings us to artificial intelligence. AI is rapidly becoming the newest frontier in finance. Algorithms now decide who receives loans, who gets insurance, who receives investment opportunities. Soon AI systems may negotiate transactions, design financial products, and manage portfolios with minimal human oversight. And when that happens, if an AI discovers a way to generate extraordinary profit by exploiting a legal loophole that humans never noticed, is that innovation a crime? The answer will not be found in computer science. It will not be found in politics, because every definition of financial crime contains an implicit moral judgment about acceptable behavior. The reality is that financial crime is rarely about money alone. It is about legitimacy, it's about trust, and above all, it's about power. Who may create money? Who may move money? Who may avoid taxes? Who may access information? Who may take risks? The answers to those questions have changed throughout history, and they will continue to change. That is why the boundary between innovation and crime is never settled. It is constantly being renegotiated. And perhaps that is exactly as it should be, because every generation inherits financial institutions built for a previous age. Innovation tests those institutions. Crimes exploits them. Regulation repairs them. And then the cycle begins all over again. So let me leave you with one final thought. The most important question for the future is not whether new financial technologies are legal. It is not whether they are profitable. It is whether they deserve our trust. Because trust is the real currency of finance. And throughout history, the struggle to define trust has always been inseparable from the struggle to define crime. I must challenge regulators, central banks, governments, and even this audience's assumptions about legitimacy. It shifts the talk from financial crime is bad to a much more intellectually uncomfortable question. Are some financial crimes simply innovations that have not yet gained political acceptance? Thank you.